from a common man perspective, they always go with a plan. Right? This is what my agenda is, and this is what I want to plan it for. And here is my affordability. And there are going to be different scenarios, and even to show that there are going to be much of a need for long term.
Who will be taking care of the family? Now, should the wife cry for the guy, or should she cry about the amount of pressure that she's going to see just in terms of taxes? There is a time frame that we cannot pull the money. Let's say 5 years, 7 years, 10 years, whatever, it depends on service provider, right? These are not available for common people for a long time from the beginning, right? But
Is that because of affordability or?
It's a big, yes. Affordability, people also don't know. So if you are putting $200 a month, so 75% of that $200 will go into investments, into the market, into whatever the funds that we invest in. Choose when we are your advisor, our advisor choose.
Hello everyone. As you know, in our recent episode, we were talking about how 60% of North Americans were unable to afford an emergency fund. We believe you are not one among them. The foundation for the financial strategy is protection. In today's episode, we will know about what protection is, what are the pros and cons of having a protection, and how it is going to benefit based on their individual scenarios. In general, the meaning for protection is save something before it happens. How this is going to relate to a financial strategy?
Yeah, so basically last week when we were discussing about the financial strategy in the previous episode, we went through designing of financial house. So the very first thing that we see as a foundation is protection. Pillars are debt management on each side, and then the ceiling will be your emergency fund, and the roof will be your investments. Basically, whenever we talk to people or any other institution, let's say for example, if you go to an institution, once you land in Canada here, the very first thing that you might have done would be after your SIN and everything, after your all your government stuff is done, is opening a bank account, right? But when you went to the bank, the very first thing the bank people will say is offer you a credit card, open your account basically, and offer you a credit card, and then they'll give you suggestions. Who your advisor you had your appointment with, they will explain you about TFSA, Open, RRSP, blah blah whatever. Right? There are different kinds of investments, which is good by the way. So these institutions, they only concentrate about the pillar. They talk about investments. There is something called emergency fund in between, which they may not. TFSA we can say it's emergency fund. Yeah, so they are only talking about the portion of the house that is above the ground, but there is something that is below the ground, which is foundation, which is protection. Protection is nothing but, I would say, insurance, right? Every time if people hear the word insurance, people will run away from that. If you meet somebody today, for example, if I say insurance, even many people, as soon as they heard this word, people might have tuned this program off too, right? Some people might have left already. But the reason why is people are scared about insurance. And people are trained in such a way that always people assume as soon as they hear the word insurance, people will run away. Yeah, basically life insurance is a critical financial tool that provides peace of mind and financial security, not just for you, for your loved ones. Because in case of an event, so for example, if a guy X has amassed certain amount of money, in case suddenly if something happens to him, what will happen to his family? So for example, this guy X has a debt of 500,000 or 800,000, let's say, the basic number that we have for houses, right? So 800 mortgage. His wife is not working. He has 3 kids, and his income is 130,000, 140,000 a year, and he has certain amount of savings in his bank account, certain amount on his TFSA. So tomorrow and he has let's say he has a car loan, and whatever the other loans that he have, bank, credit card, and whatever cards, right? For some reason, something happens to him. It may be illness, or it may be an incident or an accident or whatever, right? Something happens to him. Now what will happen to the family? Who will be taking care of the family? Now, should the wife cry for the guy, this guy X, or should she cry about the amount of pressure that she's going to see, just in terms of taxes, probate, estate, and whatever? She's going to lose everything, kind of everything, right? Because if she's not working, even she's working, can she, even if, let's assume she's working too, with her 140,000 salary, can she afford paying for the mortgage alone, and paying for the car loan, paying for the credit card, paying for the kids' education, paying for everything, for the lifestyle? Everything will change. Now who will protect them? So this is where insurance comes in, right? This is the reason why we say insurance as a protection. That is very important, and most people should consider building their financial house on a foundation called protection, which is insurance.
So that is why insurance is one of the insurance is called protection, right?
Yeah.
So it is very much relatable. Like the foundation, where the protection is the foundation. Whatever the savings that family has, I know it can be a TFSA or can be different type of investment. The moment an incident happens, the financial home is going to collapse, because the family is going to have a financial crunch, and they have to, the first thing they have to look after is to spend all the savings to come out of that debt.
No. That's a different story, right? Savings is a different story. So okay, so X has this guy X. He has 400,000 in his savings. As soon as something happens to him, if he passed away, then what will happen to his accounts? They will all have to go through a process called probate. Right? Wife will not get anything. TFSA, whatever amount that he have in TFSA, will come, yes. But before, other than TFSA, there is a high chance. There are certain ways that RRSP may also come, but RRSP will also go through probate in certain cases, right? Most cases. So now, in case if something happens, so he already is done, he is gone. So he has $800 whatever, and then overall he has $1 million debt, let's say, cars, students, loans, and whatever, right? So the very first thing, the money from his account will go to tax. That is what something people forget here, right? Before anybody touches that money, even his wife or family touch the money, government will come behind his account and start taxing his account. If his estate value is above certain value, that is fine, because he will only have to pay very minimum amount of whatever, which is anywhere between 54 to whatever, right? $1,000. If it is more than that, then everything he'll have to pay estate tax and probate tax and whatever taxes, right? After that, people will think, okay, so his tax is paid off, but the thing is, the huge amount of money will go in taxes, huge amount. After that, people will think, okay, wife may think, taxes are done, so I can now take out money, right? No, wife will not get anything even then, because the next priority will be for creditors, which is the mortgage guy, the car guy, the student loan, this loan, that loan, whatever, credit card, banks, or whatever, right? They will get their money back. They will have to take money, or they will ask her first, okay, how are you going to take? How are you going to, can you afford to pay? Will you be able to pay for the house, right? If she cannot, then she will have to sell the house and go, right? Foreclosure, whatever it is, right? So, what can she do now? After that, there are different other procedure, right? That's called probate process, right? After everything is done, they will not get nothing. I will not say nothing, but they will get a very minimum amount compared to what his husband, her husband, or their father, the kid's father saved for them. So this is where the insurance comes in play, right? Savings, taking money from the savings, from the bank account, that's all gone now. Once something happened to this guy, his account is locked. There won't be any access until all the process is done. What should they do now? This is the reason I said, for whom should the wife cry now? Should she cry that the husband is gone, or should she cry for her current situation that she's going to be in? Right? This is where the protection comes in, which is insurance. Let's say the same guy X, if he has an insurance, there are different types of insurances again. Right? People usually think, okay, this is the insurance, I don't get anything or whatever. People are not aware of what kind of the different kinds of insurances too. Right? Let's say for example, this guy has a basic insurance, whatever, $1 million, whatever. Right? So he passed away. Now what will his wife do? She has to pay taxes, right? She can get the money from insurance. Again, there are different conditions on how the claim process goes through, but she will get the money. Once she get the money, she can now pay her taxes with that money, and she can get to keep her property or bank or money. The best thing that this guy X did is protecting his family. So now you may know what that protection means, right? He is here, that's fine, he can take care of it. He is not here, he's still taking care of his family by ensuring their security through the insurance. So he is basically protecting his family even after his death.
Basically, a life insurance is not for someone to use when they are alive. It is going to be useful when the person who was basically earning for the family, if he is no longer available, or if he in this world, this life insurance is going to replace his position in the family to secure the finance for their family in his absence.
No, that is the common perspective that most of the people know. There are different kinds of people. Every time the topic insurance comes in, the people always think, okay, even I had some clients before, right? Or people that I made. If I'm not here, why should I worry about them? That is the common thing. So insurance is not just for in case of something happens in future, right? It's not like that. There are different kinds of insurances too, right? There are the 90% the majority of people know about term insurance. T10, T20, T30, T90, T100, what are different kinds of insurances there, right? Which is term. So every time you get a call, some bank, some institution, some mover, right? Somebody will call, hey, but you are eligible for so and so whatever insurance. We are offering you insurance. You will get a coverage of $1 million, blah blah blah. You have to pay $45 only, and you are done. You are set for good. And if you go through that documents, first thing, it is T20, T10, T30, whatever. People should know what kind of insurance they are going into. If it is a term, it is good based on their financial condition at that time. Yes, that's a good product too. In case if something happens, they are protected for that 20 period, 30 period time frame, whatever, right? But there are other kinds of insurances too, which people can use as savings products. Savings product, a best saving product, right?
So what you're trying to say is that the term is basically a temporary insurance, so which can expire once the number of term ends, and the other insurance is going to be permanent insurance, which can be used as a investment or a savings vehicle.
So there are two kinds of people, right? People who like to rent, people who like to buy a house, stay in their own. So these are same. This is same like the house. Term insurance is nothing but rental property or renting, basically for renting. Permanent insurance is you are owning your house, you are staying in your house until you sell it. That's your house until you rent, right? As long if you don't sell it, you're going to stay there. But even if you buy a property, that's your house, right? So there's a huge difference between renting and buying. You owning a property, not buying, owning a property. Insurance is the same. Term insurance, you are renting your protection or policy until the 20-year time frame. But permanent insurance will be there until the set coverage, until the plan is around 30 years, 40 years, whatever you pay. But your life is covered until 100 years, whatever, right? That is the difference between term and permanent insurance. But there are different kinds of insurances too. People usually, I only question that I would like to ask, if you are buying a car, the very first thing, the showroom people or the company that's selling you the car, they will ask is insurance. Why? You think they are caring about your life? You think they are worried about your family? No, that car insurance is not for them. They are trying to protect themselves. First thing, right? Second thing, the insurance for the car is not for you. Insurance for the car is to protect somebody else's life. How many times people get into accidents?
Chances are less.
Very less. But still people, it is a mandate, kind of a mandate to take the car insurance. And that is to secure somebody else's life or somebody else's property. Right? Then why don't people think about their own life, their own property, their own family, right? Their own assets, I would say. This is where people kind of jump into decisions, people run away from whatever. Right? I would say more than car insurance, life insurance is very, very important. Right? There are, as we discussed before, there are different types of insurances, no matter which one. If it is so, if somebody is looking into that, then people should talk to their advisor and get their need analysis done. Right? It is not just like that, okay, somebody calls you on the phone and say, here, you are eligible and whatever, blah, blah, and then just buying an insurance from them. There is a certain set of criteria that we need to follow to decide or to know how much insurance we need.
Oh, that's one of the major questions that every individual should ask to make sure they give the priority for themselves before it is being given to property. Even the same example, right? You can still live in a home, like either you rent or you own it. You still need an insurance. So like the car insurance, if you own a house or if you rent a house, and insurance is important. You will not be given a home for rent, or keys will not be given to you unless otherwise there is insurance. That insurance is going to cover anything and everything for the home, not for the individual. So this is another area where the question still applies. Why people are not considering taking an insurance for themselves, which is going to benefit them in an unforeseen situation. So when you said about term insurance, there are different types of term that is available. How a family can decide what term is suitable for their family?
Yeah, if they want to buy any kind of coverage, yeah, they are free to go and buy the coverage. But before they buy a coverage or buy a plan or buy the term insurance, they have to know what they are planning to protect actually. If a person has certain amount of debt, certain amount of expenses, certain amount of lifestyle, whatever it is, right? Certain amount of certain income. Insurance need to be calculated based on those criteria. It's not just like people walking into a bank or into some institution and start say, hey, I want this amount of, right? But it also depends upon, there are different kinds of term insurances too. How can people, for example, if a guy with a low income, he still wants to protect his family in case if something happens to him, then there are certain plans for him that he can go still go and further protect his family. It is only valid up to a certain period. If, for example, T10 or T20, let's say, that's the most common use, T20, which is term 20. From today, 20 years later, next day, the same minute, your policy will expire. That 20-year period, yeah, you are covered for whatever, $1 million, $45 per month, whatever, right? You are covered. But people should ask, okay, what if everything was fine with me, my health is good, my condition is good, everything is good with me. After the 20 years, what should be done? Because for a guy with 30 years of age, a person with 30 years of age buys a insurance now for 20 years. By the time he becomes 50, his policy will expire. And after that 50, he would have amassed more wealth or more property. Kids would be grown up, right? More debt too, we don't know, right? And his family's expenses and everything went up. His income went up, right? So now he needs more protection. So now if at that age, like at 50 years of age, if you want to buy the same insurance, now to extend his life by protection by next 20 years, so T20, another 20, how much do you think he will pay the premium? Now he is paying $45, right? For example, just say for example, $45 $1 million coverage.
Maybe 5 times of it.
Alright, it will jump up. The minimum it will jump is at least 12. At least that is what my opinion, I would say. 5% is a very less amount. Right? It depends upon age. There are different other factors to consider too. What if he became diabetic? What if he got some issues like recently COVID 2019? People who got their insurance before COVID had certain kind of conditions. People who got insurance after COVID have certain kind of criteria to deal with. After that 20 years, if nothing is wrong with him, his policy, his premium will jump at least by 12% minimum. So can he afford to pay 12% more? 12 times, sorry, not percent. 12 times, sorry. 12 times. So 45 into 12 is what he's going to pay, which will become $500 a month. Can he afford it at that time? That's what some people need to think, right? There are certain features for there are features for every kind of insurance. Each kind of insurance has their own features and benefits and disadvantages too, right? So the biggest advantage for temporary insurance is its affordability. People, anybody can buy insurance nowadays. Term insurance is the most affordable insurance policy that anybody can buy with the least amount of money, less than $60-70 a month. And what are the benefits? What other benefits it have is the face value, which is $1 million coverage or whatever the amount that they take, right? So it has it has a coverage value, death benefit basically, for that period of time. The disadvantage of this policy is it has no savings part, no cash value. So it is like renting a house, as we discussed before, right? It is like renting a house. You keep paying your $45 a month, right? Let's say $500 a year, and for the next 20 years you are paying, which is $10,000. So you pay $10,000 to cover your life. In case if something happens in between, unfortunately, then your family is protected and they'll be good. And if it is not there, then the amount so far you paid is done and gone. You'll have to go for another coverage for either 20 years, 30 years or whatever, and your premium will go up and whatever, right? That flexibility. Or the only advantage of this is you will get a coverage for a certain period of time.
So the another good reason why I see people go for a term insurance is when they get into a debt. Let's say, this is from one of my clients, right? So basically, when they had a beautiful life renting their home, they had to get into a situation or kind of a social inspiration and get and own a home. They got a home. Now they had a $800,000 debt on the home, and which is for close to 25 years to 30 years amortization period. So this is where the owner of the property, he got the same ideology where the affordable price of insurance what I can get is term insurance, and he had the confidence of paying it out in about the given amortization period. But in case if something happens, right, that but is the very important factor here. Anytime we say any insurance that is being bought, it's not highlighting that they are going to get into some kind of unforeseen situation. It is more kind of an insurance to say if it happens, only if it happens, it is going to not have much of an impact on that person. Likewise, he had the same idea. For the next 30 years, before I pay off my home, if something happens, this insurance money is going to cover paying off the home. After 30 years, I will not be having no debt. That is his confidence. So I'm good with the term insurance, not to go with with any different type of policies.
But did somebody explain him about what kind of insurances are we have in the market now?
Yeah, he knows that. Yeah.
And still, why did he prefer only?
It's basically the affordability. The other options with the amortization, like for the mortgage money he need to pay, he is not the affordability is not there for their investment. Now different type of policies compared to term, and that is where he opted for term insurance.
Yeah, going for term insurance is not bad. I would not say he has some kind of coverage for a certain period of time, whatever, right? But only thing he need to worry about is, okay, his amortization period for the loan or mortgage, whatever, is done. Now, this is when the next phase of issues will begin for him. How is he going to protect his assets? Saving himself from debt or his family from debt is a different thing. protecting his assets is also a different thing. In case of an event, what will happen to those assets? So basically the thing is, they say only thing that people need to worry about is here in North America, they say they will be taxed when they are born, they will be taxed when they are growing, they will be taxed when they are working, and they will be taxed after their death. So who is going to cover that portion? Now he is already, the first three conditions are all done, he is now loan free, whatever, right? What about the last one? That is where people need to think. He's going to go for another term insurance, that's fine. But at that time, will he be able to afford it? And the second thing is, he also, at that time, I don't know what his age is, I don't know his details, by the way, right? Anyways. But how about his age? Will he be insurable? That is the first thing. That is fine if somebody, not your client or whoever, right? If somebody is going for T20, T30, whatever, that is fine. But if you are already aged, by the time your policy ends, then is it really worth to take that? After that, what will happen if the policy expires? Once his 30 years is done, whoever, right? Let's say, I do not want to use your client, whatever details, right? But somebody, generally somebody, John Doe, whoever, right? He said, okay, his loan or amortization period is done for the house. It is done now. So he's debt free. No, he's mortgage free. Right? So 20 years, 2 days after the 20 years period is done, something happens to him. We never predict, right? We cannot say, right? So if something happens to him 2 days after, let's say 1 day after your policy is expired, then what will happen? These days, all this time here, this guy John, whoever it is, he is too confident that, yeah, you know what, I have 20-year policy, my 30-year policy, the policy is 30 years, and my loan is only 25 years, blah blah blah. I'm covered for additional 5 years, and a day after the 30 years is done, what will happen to his property? Everything will be locked out. At least his portion will be locked out in estate. Now where should the wife go to get that property back? He is having certain investments in his account. He is having certain investments in his investments, right? On his name. Everything will be locked. So that locked amount will have certain tax, certain value, which will be way above the value that government set for the estate, with like the minimum value. 100% sure. So where will the wife pay the taxes from?
From a common man perspective, they always go with a plan, right? This is what my agenda is, and this is what I want to plan it for, and here is my affordability. And there are going to be different scenarios, and even to show that there are going to be much of a need for long term, taking insurance for longer term. But if they are unable to afford, they will go with what they could.
Exactly. Yeah, I agree with that. But taking a term insurance is not, I'm not saying that it is bad, but there are way more different products available now, or made available for people to take advantage of, and people are not knowing them because nobody is teaching them, right? Majority of the financial institutions or organizations never explain this stuff to general public, right? They always talk about, make some call about this what you call term insurances and whatever, right? But people should also ask them, whenever, if somebody got a call from some institution saying, hey, you are eligible for this insurance, you will get a coverage of 1 million, blah blah blah, pay only $40, $30, whatever per month, which is good. But I would say, or I would suggest, if somebody makes a call, or even if people walk into the institution and ask, in search of an insurance or whatever coverage, they have to ask them, is this policy post underwritten or pre underwritten? That is a main condition. People are not aware of what they are taking. So many of the policies are post underwritten. That means you'll only start the underwriting process after the incident. So at that time they'll go back in their medical records, do check whatever conditions and everything. Now after that incident, so everything before that incident is now a pre-existing condition. Now he is void of his policy is void. The only the main advice that I would give the people, I will give to the people is going for a term insurance is good. That's fine. It's based upon your affordability or whatever condition that you are in. But there are many there are some products called convertible, renewable and convertible products. So which one you can always take the product convertible to a permanent product. So term convertible to a permanent product. That is there advantages? Yes, there are advantages of its own. The disadvantage is the premium may go up a bit higher, but you are covered for life.
Like you said, term insurance have different terms, like different options for people to go opt for. And when it comes to permanent insurance, what are the various options that are available, and can you talk about it?
Yes, there are different kinds of permanent insurances too. But before I go into permanent insurance, there is the major disadvantage, or one of the disadvantages of having permanent going for temporary insurance is if you stop paying if you start missing your premium, you are done. Your policy is gone. You did not wait until 20 years because it has no value. You are paying $10,000. Your cash value is zero. You you miss one premium. Your policy is done and gone. Is cancelled, will be terminated. But yeah, when it comes to permanent,
is that not the same with the permanent insurance too?
No, yeah, I'm coming to permanent insurance. There are different kinds of permanent insurance too, right? The whole life insurance and different. The advantage of going with permanent insurance is you will have a certain face value. Let's say a person of 30 years of age will get a coverage of $500,000 for certain premium. Right? Premium, I cannot give you a premium. Let's assume. Let us say it's $250, $200. Let's say $200 a month. So yearly is paying $2,000, $2,400. So $2,400 he's paying for a face value of $500,000. If you pay for, let's consider T20, right? For the same 20 years, in term insurance he's paying $10,000. Zero cash value, right? But here, $2,400 into 20, $48,000. He's paying in what? 20 years, right? In the same 20 years, term insurance will have zero, but permanent insurance will come with a cash value, right? To the most part, after your 10th year or 11th year, the amount of money that you paid so far as premium should match your cash value, right? Let's say you paid $20,000 in first 10 months. By the beginning or by the time your policy reaches 11th year, your cash value will meet that $20,000 in your account.
So that is basically the beauty with the permanent insurance now.
Yes.
So you are getting an insurance without having any money invested towards your insurance, but you have invested already.
No, there will be a coverage too.
That's what I'm saying.
There will be coverage with certain. So you can use this as an insurance policy and also as a savings instrument for your saving. And the only disadvantage with that is the very first there is a time frame that we cannot pull the money. Let's say 5 years, 7 years, 10 years, whatever. It depends on service provider, right? After that 10 years, if you want to remove your money back, you can close your policy and take it back, right? To the most part, people don't cancel the policies. This is where the rich people come into play, right? As far as I know, these permanent policies are not available for common people for a long time from the beginning, right?
But is it because of affordability or
it's a big, yes, affordability. People also don't know, right? But most of the rich people, they will put money into insurances, like permanent kind of insurances, because they want to secure their assets, they want to secure their property, they want to secure their whatever they have, right? So permanent insurance is what not rich people. Nowadays it's available for everybody, but it's basically designed for rich people, super rich people, basically, right? The only disadvantage with permanent insurance is the premium. The premium is will be a bit higher than term insurance, but it has its own advantages.
And the reason is obvious, right? Why the premium is little higher than the term insurance?
Yes, because certain amount of money is going into your investment, right? The money that we are investing into policy is going into investment, into the market. And whatever, let's say, let's take an example, right? Like it's a bucket. We are putting money into the bucket, and in that bucket, just for an example, right? So if you are putting $200 a month, so 75% of the $200 will go into investments, into the market, into whatever the funds that we invest in, choose when we are your advisor, our advisor choose. The remaining 25 will be protecting you and your family in terms of with the insurance.
Like the term insurance, does permanent? I know at least permanent insurance have at least two types of different permanent insurance. In my in my awareness, uh, is there many variety of or many options in a permanent insurance available? Can you more talk about the pros and cons in the permanent insurance and its types?
Well, there are different kinds of permanent insurance as well. Same as in term, as how term is classified. Right? There are different types of permanent insurance, but the commonly available insurances for common people are whole life. Everybody know about it, whole life, and universal life nowadays. That people are, and even in universal life has different kind. Even if you go further, there are different kinds of universal life policies too, right? Which is segregated between kids. Kids have their own universal life. People like normal, like elders or everybody else will have their own universal life, whatever, right? But even that has different. But anyways, whole life, biggest disadvantage or the only disadvantage with the permanent insurance is premium. The premium is high, but the advantages are you're covered for life. Unlike in term, it's not a term based, right? Until 10 100 years, right? Or until your life, whole life. The second thing is your policy will have a face value, which will grow or grow by time. So after your, let's say, after 60 years, 70 years, whatever the term that we are paying premium, after that our death benefit will, at certain point our death benefit will also start to grow, right? The third thing is we'll have the cash value, as the amount of money that we are depositing into our account for our protection will be placed into an investment bucket which will grow by time. But compared to whole life and universal life policies, the disadvantage, I don't want to say the disadvantage, but whole life policy, the premiums are fixed. Let's say if you miss premium, it is done. We cannot change the premium. If, for example, if for Bharat you are taking $400 per month premium, you will have to pay $400 per month until a set period of time. If from whichever age you are taking, until that period, for the rest you have to pay that 400 permanent, right? But in case of universal life, it is very flexible. This is where common people, right? Where people think, so most of the term insurance people who go for term insurance can look into universal life. For example, if today they are working good, they are getting overtime, they are working, their income is good, everything is good, so they are paying $200 a month. That's fine. They will pay for 5 years, 6 years, whatever time, right? Suddenly something happens in their job, layoff or whatever condition, the financial condition change, or COVID comes in next time, COVID 2, 2.3, whatever, right? 2.1, 2.2, whatever. That time, they will always have a flexibility to pay only the minimum amount, which will again come up to $65, $70, whatever time, whatever, right? Depending on the age. So in the term insurance, you are paying $65 for $1 million coverage. You are paying the same $65 or $70, $80, whatever. You're still paying the same. The advantage is your policy is still live. It's not expired. In case if you are not able to pay that money to, you cannot even afford that $80 to, then you have a flexibility of holding onto the payment for a certain period of time. Then people may ask, okay, why is not the policy expiring? Because at this point, the cash value in your account will come into play, and your policy will pay for that, right? So you are protected for life.
So with these many variety of options, as you have explained, is there any specific strategy that you can explain, how an individual can choose what kind of policy will be suitable to get their insurance?
Yes. So based on the topics that we discussed, it depends upon the need, right? It depends upon the affordability, depends upon the condition, financial condition. If somebody is there, he cannot afford $200 per month. On the same way, he do not have too much mortgage, do not have much load on him financially, do not have much pressure, right? He do not have more assets or whatever that he need to cover. There's no point for him to. No, he can still go for the permanent, but he if he cannot afford it, then he can go for temporary insurance. His family is protected, everything is protected now. In case if something happens to him, then his family is okay. At least will be okay. And meanwhile, if as a time goes on, if his family situation or his situation gets better, then he can go for permanent insurance or whatever, or he can either renew his policy at a later date. When it comes to universal life, it is suited for people who are looking for a lifetime coverage and who want to protect their assets, who have certain amount to protect, who have mortgage, right? Like basically, who want to develop more cash, right? Who want to generate more cash, right? And who can afford paying higher premium, they can go for the universal life. It's like not, I don't want to say universal life, but the whole permanent life coverage, right? If you can afford, if his situation is good, if he can afford to pay higher premium, right, and he wants to generate some cash as he go, right, and then if he can protect his life and his family, then that's the coverage that people can go with permanent insurance.
Which means the life insurance is basically depending on an individual financial need and their budget.
Yeah. Mm-hmm.
So what type of policy to get is based on their financial need, but the underlying statement is whatever the policy you want to choose, you can choose, but make sure you choose one.
Make sure you are always protected. Always protect your family. Make sure that your needs are covered, even if you are here or after you are done, after you are passed, right?
Yeah, and also there is a myth, right? Why I won't say myth. In many cases, people procrastinate saying I will get insurance later, and people really need to know this on or when they need to go get an insurance. The answer is it's supposed to be yesterday. If you haven't had one,
Yes.
go for it now. The reason, sooner you get an insurance, it's going to save you a lot of money in terms of how much of premium you're about to pay on a monthly basis. Basically, when the person is younger, it is considered that the person is going to be healthy on a very higher or a significant percentage on the higher level. As the person gets older and older, their health deteriorates, and no matter what, I would say, based on the general data available, on the health or in the medical information bureau, on an average, if the people is falling under a certain age category, there are going to be some common symptoms or a default set of diseases, or you can say critical illness, where they are potentially vulnerable to. So based on the age, the overall premium is going to increase a lot. This is where a person who thinks at the age of, let's say, I myself who was at the age of 30, I had an opportunity to buy insurance. I see the insurance, it is, let's say, $100. After 3 years or 5 years, no, I can wait for 5 years and then I go for it. In 5 years, I'm 35. At the age of 35, there are common symptoms of having certain critical illness. So all those factors will be added into the age criteria. Now the same coverage for a policy, it may go higher price. Definitely it will go higher price because as the person gets older and older, their chances of getting an unforeseen situation is highly likely possible. It's very similar to a hypothetical situation. When you buy a car, you are asked to get a car insurance. It doesn't mean you will be getting into an accident. Even if you are doing well, you are making sure If something happens because of a reckless driving or a careless driving from the surroundings, you have been covered. We had a very good session talking about the protection, the fundamental of the financial strategy. The foundation is protection, and we talked basically about life insurance. But protection, the life insurance is when the person is not going to be available in this world. When the person dies, how that insurance is going to be really a protection for their family. Likewise, there are different insurance for protection in addition to life insurance. There are critical illness, there are disability insurance. We will be more discussing about the additional set of insurance, or the other pillars in the financial security in the upcoming series of this episodes. Thank you so much for watching this episode today. Please comment us with your current situation on having a life insurance, or if you need any help or advice, you can send that in the comment, and we can respond you back. Thank you.
Thank you very much, everyone.